Target stock is crashing. Walmart stock is crashing. A U.S. recession is now the base case, according to Wells Fargo. Folks, the stock market is falling apart right in front of us, and that is when great investors start to relax and be as calm as possible, because moments like this don't come around very often. Quite frankly, and more accurately, since 1987, we have not seen a drop like this in Target Corporation. In one day, down over 26%, bringing the year-to-date drop on Target stock down 31%. That is on the heels of reporting Q1 earnings, which are almost exactly like Walmart. The fact that we had decent revenue growth, relatively strong comparable sales. You had digital sales continue to grow, although not at the pace that they once did. Guidance came in, but what also came in in a major way were profits over at these companies. We did not see Target and Walmart pass the price of inflation down to consumers, and it hurt the bottom line. We'll get over to the numbers over at Target. I'll show you how this impacted this company. We'll see it from a cash flow perspective. We'll see it from a profit and loss perspective, and we'll see if this company is in any kind of financial trouble, because as we start to look to the valuation of Target, it is pulling back, and quite frankly, it's actually south of one-time sales now. We'll also look at this from a technical perspective. When you drop this much and you have this big, gigantic red candle all in one day, it certainly gets the idea that maybe now it's time to start buying the dip, as it appears investors are starting to panic. But let's walk through this step by step, understand what we're getting ourselves into over at Target. Now, the first thing to understand is operating margins and gross margins, otherwise known essentially as profit, are starting to shrivel up at these larger retailers. First quarter operating income margin over at Target was just 5.3% in the quarter. That was 9.8% a year ago. Inflation just absolutely destroying this company's profitability. First quarter gross margin was 25.7%. It was 30% last year in 2021. It's just showing you that the margins are really taking a big hit over at these companies. Again, it doesn't appear they're passing along all of the price increases that we've seen from a labor perspective, from a cost perspective. They're not passing that down over at Target and Walmart yet, and it makes you wonder, as a macroeconomist or certainly somebody that's monitoring Wall Street, well, when Target and Walmart start passing the costs down to the economy, guess what's right around the corner? Likely a recession. Now, let's move into that, because quite frankly, you look back in the history of time, and buying stocks during and after recessions turns out to be a wildly profitable strategy. In fact, one that works 100% of the time. Will Target be in those basket of stocks that you purchase? We'll talk about that. Total revenues came in at $25.2 billion over at Target, just 4% growth year over year. Again, factoring in inflation is at 7, 8, 9, 10%, just 4% growth on that revenue side. Not very impressive. Now, look what also exploded. Your cost of sales went up right in line with inflation, right at 10%. So you guessed it. When your sales go up only 4% year over year and your cost of those sales go up 10%, that's a problem. That is going to absolutely destroy your operating income, which we'll get to here in a second, because we also have the all-important selling general administrative expenses. Those were up 5.6%. So both of our input costs over at Target, the cost of the sales and the selling general administrative, both went up in excess of sales. That means your operating income right here, which is essentially revenue minus your cost, is going to implode. In fact, that was down 43% year over year, $2.3 billion last year on a quarterly basis, all the way down over $1 billion to $1.3 billion. So despite raising your sales by 4%, your operating profits absolutely got obliterated because of the inflationary environment that we're in. You pull down all the way to net income, you're making $2.16 per diluted share. I'll show you that from a dividend perspective, well covered still over at Target. So if you think this is a one-off quarter, or if this is maybe the next 3 or 4 quarters, the company has plenty of money to pay their dividend. What they also did is they retired a large amount of the shares outstanding, 7% to be exact. And we'll show you from a financial perspective, maybe this wasn't the best idea. And certainly when the stock is down over 25%, the fact that executives retired a large amount of the shares at a much higher price price, that's going to rub investors the wrong way too. From a balance sheet perspective, doesn't look that great over at Target. Look at our cash and cash equivalents over at Target. Where'd they go? We got $1 billion. In January, we had about $6 billion. Last year, you had $7.8 billion. Now, a lot of it is flowed into inventory. You see here on our inventory line, 10.5 last year, all the way up of over $5 billion to about $15 billion worth of inventory. But we see still our total current assets, which is our cash and our inventory primarily, and you've got some other assets here, although that's relatively flat on a year-over-year and quarter-over-quarter basis. Our current assets went out the door by nearly $2 billion. You went down from 19 billion down to 17.9. So that should have you a little concerned as an investor. The fact that you've got a lot of money tied up in inventory, are you going to be able to pass that price down onto consumers? And certainly if the base case is a recession, how many people are going to be shopping at Target remains to be seen. Now, from a liability perspective, not a lot here. Okay, I say only $13 billion in debt. I tell you what, when you only got $1 billion in cash and you got over $13 billion in debt, not exactly the cleanest financials here. When we get over here to a cash flow perspective, it's going to paint a similar story. You pull down those net earnings of $1 billion. Last year, it was double that at $2 billion. You get to add and subtract those things. Some things are about the same year over year, but what the big change is the inventory. They burned through $1.1 billion of cash to generate on inventory, and that really killed our cash flows. Notice we were cash flow positive last year, 1.1, due to spending about $1.1 billion on inventory or burning through that cash in the most recent quarter. Well, all of a sudden, now you're sitting at cash flow negative over at Target. We saw the exact same thing at Walmart. These financials are exactly like Walmart. You had sales increase just marginally. You had cost accelerate. In fact, cost of goods over at Target accelerated far faster than over at Walmart. That led to negative cash flows in the quarter as the company stacked up inventory as well. Paints a very, very bad picture from a cash flow perspective. Now, what also burnt even more cash out of the company was they did an accelerated share repurchase. This was sometime prior to May 1st, and after you see the stock decline 25%, that means Target did an accelerated buyback up here over at probably $220 per share. That timing looks absolutely disastrous. You did have some dividends in the quarter. You did have some small reduction in long-term debt, but the company blew through $4.8 billion bled out of this company just over the last quarter. It doesn't take a genius to understand that Target better not do that again, because they have just $1.1 billion sitting on the cash balance sheet of this company. There is a reason why this stock went down this much in one day, because if you have results like this that repeat themselves, even just one more quarter, let alone 2 or 3 quarters, well, guess what? Instead of buying back the stock over at Target, guess what they're going to be doing? They're actually going to be issuing it in order to raise cash, or they're going to have to increase this debt position on the balance sheet, probably at much higher interest rates than they could have in years past. That is going to weigh on this stock now and into the future, and quite frankly, on a lot of stocks. From a technical perspective, paints a pretty ugly story. This stock got really blown up over $200 per share, well north of one-time sales. Because some of you might be looking at this and saying, hey, look, this company has $25 billion worth of sales in a pretty rough quarter. The company at the current time is valued at about $73 billion. Again, they don't have a lot of cash, so you can't necessarily subtract that off of the market cap, but some of you starting to do the math. You're paying south of one-time sales for Target. So what I did here is I brought up a 10-year chart of Target showing you that this company is traditionally priced underneath sales, oftentimes bottoming down south of 0.5 times sales. So right now at the current time, Target is trading at about 0.75 times sales. It probably will likely go lower. And also the other thing about Target is they are not quite as well capitalized as some other retailers are. And I'll be interested to see how management kind of cleans this up, whether or not they expect cash flows to turn back positive because they're not going to have to invest as much into inventory in subsequent quarter. That certainly could be the case, but I could see from an operational perspective, the company continues continues negative cash flows, are they going to issue the shares and raise money that way? Are they going to take on traditional bank financing? We'll see what Target decides to do. I am no way saying that I think Target is going to go bankrupt or anything like that. There will be people that will line up across the streets to lend this company money on their receivables and their inventory number, but it's likely something that's going to have to be addressed, and we'll see how management decides to do that in the coming days and weeks ahead. From a price perspective, from a technical perspective, looks completely broken down, looks quite frankly like it wants to pull back down into the longer term up channel, which if it does in a very short amount of time would get this stock down south of $100 per share. Remember that these downswings will probably take some time, and as that time progresses, these upper channels continue to go up. I could see this stock pulling back into this channel, maybe at the 120, 130. Again, this is no exact science. This is just showing you how I would project Target stock over the next, we'll call it 3 to 4 months. I would expect this stock continue to channel sideways and down, pulling back into this downward channel. I think once it pulls into that downward channel and you have greater clarity over the capital structure over at this company, are they just going to burn through this inventory and generate cash that way? Are they going to be able to maintain margins and keep them under control and not turn to operating negative? Are they going to be like in a holding pattern like Walt Disney was during the pandemic, keeping parks just marginally profitable as they wade through the tough environment? We'll certainly be asking these questions about not only Target, but Walmart as well, which both have seen their stocks absolutely fall off a cliff since reporting earnings. We're certainly seeing the early evidence of a recession here in the United States. We're certainly seeing that equity prices are starting to price that in. That should make you excited as an investor. You don't see drops like this every day, and quite frankly, it hasn't been since 1987. Where you've seen a drop like this on Target Corporation. I think this stock is a buy, probably not at the current price, but if your instinct is to start buying stocks, history says that when you're in recessions and just coming out of them, history proves that those are great opportunities. I would be as well prepared as you possibly can. Hopefully you guys enjoyed today's video. We'll be back again soon with more. Good luck with your investments.